Hey everybody, let me tell you a story. So when I was about 18 or 20 years old, I had a friend, and my friend says to me, you know, I would love to be a rock star and get $1 million record deal. And I said to my friend, you know, that's actually not as good of a thing as you think it is. And my friend says, why? And I say, well, because the thing is, if you were to get $1 million record deal, that now means that you have to go out and sell more than $1 million worth of your product, which is, I guess, records. And if you can't do that, that means that, first of all, you're going to be in debt to this record company pretty much for the rest of your life. And on top of that, they'll have decided that you're a failure and they will not invest any more money in you ever again to promote your stuff. And that makes the odds of being able to pay them back even worse. So that's kind of a catch-22 that you've got yourself into. And my friend says, wow, you know, that really does suck. I said, yes. Welcome to a new mini-series I have on this channel called Startup Concepts. And this episode is called Why Investment is Bad. And I'm going to try and convince you of this by sharing some of my experiences, being a startup mentor, being a CEO of a SME, small, medium-sized enterprise, and having been a startup founder myself, and having been a judge in pitch competitions where I've heard over 1,000 pitches from would-be entrepreneurs, and being a management consultant where I've been brought in to try and fix, usually not startups, but companies that are a little bit bigger that are in the growth stage and trying to get them on track. And I have a master's degree in finance, so I believe I can speak to this issue. So we're going to talk about why investment is bad. Now, here's the thing. As hopefully a lot of you guys know, startups usually fail. In fact, it's over 90% of startups that fail within their first year. And a big reason for this is money. Okay? Now, the problem is, if you get someone to invest in you, they give you a lot of money, okay? Whether they're going in with you and they're contributing their money, or they're lending you the money, whichever form it takes. This would be equity or debt financing. And you're following a business plan, you've created your business plan, but it doesn't work out. Either you overestimate costs or timelines, or you miscalculate what would sell and what doesn't sell. But for whatever reason, it doesn't work out. You now have to pay back a lot of money, especially for debt financing. And in my experience, this is what sinks a lot of startups. Now, let me contrast this to an example that you're probably familiar with. Okay, I was debating whether I would do this, but I'm going to use YouTube as an example here because it's not the greatest example, but it's an example that I think a lot of you guys are familiar with because you're on YouTube, you're watching me on YouTube. But if you were to go on YouTube and watch some videos that tell you how to start a YouTube channel, you know, what you should do to make it a success. One of the themes that you're probably going to hear is that you should experiment. Okay, try doing videos on this, try doing videos on that, try different techniques, try all kinds of things, because sooner or later, you're going to hit upon a hit, something that works. And what I think is great about this is that that's kind of how it works when you start a business, whether it's a startup or a traditional business. That's kind of how a lot of people succeed. Okay, it's very rare that someone, when they're very young, just has an idea about something they've never done before, and they execute that idea and bang, it pays off big time. I'm not saying it never happens, but it's very, very rare. It's like getting a hole-in-one in golf. It happens, but it happens very rarely, okay? So if your whole plan is based on the fact that you're going to get a hole-in-one, chances are you're going to fail, okay? The other problem is that if you've taken money, especially debt financing, where you've basically taken a loan and you got to pay the money back. and your first idea fails, it now means that you can't just simply get up, dust yourself off, and try again, because you still have to pay back the money from the first idea that failed. Now, there's some practical problems here, okay? In a perfect world, if we all lived in Silicon Valley and we all had the $1 million smile, we could get equity investment, people that believed in us and they contributed their own money. They essentially donated their own money in a way to our idea. They believed in us and they believed in our idea so much that they went in with us like a partner. And if the business fails, then they lose their money, everybody loses, but you don't have to pay them back. Okay? That would be one thing. But when we look at the vast majority of entrepreneurs, how they actually succeed in getting startup capital, it's not in the form of equity financing. It's in the form of debt financing. What tends to happen is people, unless they're insiders in the world of investors, okay, they either know the, angel investors, VCs, or they know, high net worth individuals, and they live in that world. So much so that a stranger, some investor, is going to trust you with their money. Okay. That usually doesn't happen. What usually happens is that instead, startup founders end up taking debt financing. They go to government programs and they get a grant or a loan. And this is usually, for the people who end up getting money, this is usually how they get their money. Excluding, of course, your friends and family that give you their money or invest their money in you. But a lot of these government programs, even if you incorporate your business, which you would think would insulate you against, any kind of personal liability, they make you sign a personal guarantee, which means that if you take the money and you try your idea and the business fails, you still have to pay back the money. Okay? It's very predatory in my opinion, but that's kind of what's going on. They don't really believe in your idea. They're just trying to sell you a loan. And this happens a lot more than you think. Now, everything I've said so far is very depressing, okay? But I promise you there's a happy ending to this if you just bear with me. Okay? Now, the problem here, okay, like I said, is that if your first idea fails, you can't simply just get up, dust yourself off, and move on, because now you have to pay back a bunch of money. And usually at that point, people decide to sort of cut their losses and they say, like, look, I gave it a try. It didn't work out, but hey, at least I tried. I'm going to go back and get myself a career job and go down that route and give up the world of, or the dream of starting my own business. That's a lot of times how that works out. But let's contrast this with YouTube. Okay. Now, I mentioned that like YouTube, it's not the greatest example, but it's something that hopefully everybody is familiar with. And what most people recommend when you start a YouTube channel is that you experiment, right? Okay. So the thing is, that parallels very, very well with what tends to work in the real world for entrepreneurs who succeed. Okay, the odds are is that your first idea doesn't work. Your second idea probably won't work either. Your third idea, your fourth idea may work. And if you keep persisting, sooner or later, you're going to hit on something that works. After each attempt, you'll have learned a little more. And after you keep doing iterations, eventually you know enough, you have enough knowledge and experience to avoid problems and to find success. And if you can keep up that process of sort of trying again, eventually you get there. Okay, that's the key. So that's the similarity between the whole YouTube thing and starting a business. Okay. Now, the other problem with startups, okay, and with investment is that the other thing I've noticed in my involvement with startups in all these different capacities is that let's look at the sort of what I call the Silicon Valley model, which is the standard model that people seem to use when they want to start, certainly in an innovative startup, and sometimes a traditional startup, is that they create their business plan and then they have to go out looking for money. And they are obsessed with getting money because their entire plan depends on it. And they focus so much of their time and their thought and their energy on raising capital that they hardly devote any time or any effort to their actual business. So it's a total distraction. The more you chase the money, the less time and effort you put into your actual business. And it becomes almost like a treadmill where you're just, the role of the founder or the CEO becomes the treasurer. You just chase the money. That's all you do. And then if you were to sort of look over all these objections, all these problems, and say, okay, let's pretend I actually got investment, and let's pretend then that my business plan worked out, and I was revenue positive, I was making money, and it was a hit. Then the problem is that a lot of times you don't get to keep your profit. A large portion of your profit is funneled away to your investors. So even at the end of the day, if you do succeed, the success is sort of tempered by the fact that, like, okay, you know, you're basically working for your investors. They put up the cash, and so you really become their agent. They get paid before you. And that's probably not most people's idea of success, okay? Now, a lot of people challenge that and they say, well, if you have a smash hit, you have a smash hit. I say, yes. But most people, in the vast majority of situations, don't have a smash hit. They might have a moderate hit, a moderate success. And in that situation, the fact that you've got to pay a huge chunk of your profit back to investors, that becomes significant in that situation. Okay? So, that's all very negative. Let's talk about the positive now. Okay? What I advocate for, okay, and this is what I recommend, and I don't see enough entrepreneurs doing this, is in the beginning, okay, it is very possible to substitute the need for startup capital with brains, okay? If we exercise our brains and we try and think, I hate this expression, but if we think outside the box, we think of alternatives, we can usually find ways to circumvent the need for a lot of startup capital. There are many, many business models that don't really require much startup capital. Okay, I talked about that in my previous video. Okay, they're not capital intensive. And if you have an idea of what you want to do, if you just exercise some thought, you can maybe find ways of not having to buy things. Maybe you could lease them. Maybe you could rent them. Maybe you could borrow them. Maybe you could eliminate the need for them. And you can get your business plan, if you want to call it that, down to the point where the capital requirements are absolutely minimal. Okay? You start with certain pieces of the business that don't require a lot of cash up front. And you can make this model work. Okay? Now, that's a challenge, but here's the payoff. If you can do this, okay, not only do you enable a sort of iterative model where you can try an idea, and then even if it doesn't work out, you could try another idea. And if that doesn't work out, you could get right back on the horse. You could try a third idea. And each time you learn something, maybe you have a little more success. Okay? If you can do that, not only will you succeed on your own terms, not only will you stay in the game long enough to be able to get to the point where you know enough to succeed, but then you're not paying a whole bunch of lenders and a whole bunch of equity investors the lion's share of your profit. It's a great situation to be in. And what I found is that a lot of the entrepreneurs that don't take a ton of startup capital to get their idea off the ground, they're the ones that tend to succeed. So hopefully this makes sense. Exercise your brain, okay? Try and think of alternatives. Try and question everything in your business plan that seems to require money and you don't really see an alternative. Figure out alternatives, because usually they're there. It's just a matter of questioning assumptions and looking at alternative ways of doing things. Okay? That's what I want to leave you with. Investment, when you start a startup, in my experience, is usually bad. And I'm sure a lot of detractors are going to point out that if you were in Silicon Valley and if you were brilliant, then, if this amazing venture capital firm approached you and they wanted to invest in you and they trusted you, then that would work. And I say, yeah. But take a look at statistics. How often does that happen versus how often does the failure modes that I were describing happen? I think that'll be revealing. Hopefully this made sense. Let me know in the comments if you have any reaction to this, any questions, comments. If you have any particular topics you'd like me to talk about when it comes to the world of starting businesses or growing businesses, because I'd like to continue with this mini-series. Thank you very much for your attention. As always, you guys are awesome, and I'll see you on the next video. Take care.